Understanding investor expectations can be the difference between securing funding and walking away empty-handed. In this webinar, The Investor's Perspective, we'll explore what drives investor decision-making and how to position your spin-out for investment success. Let's begin.
Today's seminar is about investor expectations. I spent a lot of time as an investor, so I do have a good appreciation of what it feels like on the other side and what therefore drives investors' approach and their behavior. So in today's webinar, I'll be explaining investor expectations when considering investment in university spin-outs. These expectations or mindsets will determine their interest and approach. They will also drive negotiations. So understanding the mind of the other side, in this case, the investor, during those negotiations is a very useful thing to know. But before getting into that, I need to provide some background about investors and investment process. In other webinars in the Campus Plus PD Plus series, I've talked about key success factors for spin-outs. At a high level, there are 4 key success factors. Firstly, a sound strategy. Secondly, getting the permission and support from the university, alignment with goals and KPIs, shared vision, and all those kinds of things. Thirdly, that there's at least one motivated individual or a team who can drive the venture, at least through its early stages. And 4, funding. So obviously, investors are part of the funding solution for a university spin-out. Understanding their expectations is highly relevant. The key thing I want to stress, though, is that investors expect that the key success factors 1 through 3 on the slide in front of you are in place. So that's part of the preparation for a spin-out, is making sure you do have a sound strategy, that you do have the support of the university and there is alignment, and thirdly, that you do have a founding team for the spin-out. There are many different types of investors, both in Australia and overseas, that could be relevant to your spin-out. A really important segmentation that differentiates investors is where the money they invest comes from, whether it's their own money or other people's money. This will strongly determine their potential interest in investing in your spin-out and their investment process. It will also determine their relevance to your spin-out as a suitable source of investment, such as at what stage, what their investment capacity is in terms of how much money they can invest or what their minimum investment typically is, and what their time horizon is. Do they have one? If so, how long is it? By time horizon, I mean, what's the time horizon in which they expect to get a return? If you look down the column, those 2 columns in the slide in front of you, you'll see that I've given some examples of investors who invest their own money, such as friends and family, individuals, angel groups and networks, family offices, perhaps your own university or research institution, and businesses. They're investing their own money. On the other side, you have investors who are generally investing other people's money. They've raised a fund from different types of investors, and they've made promises to those investors. And those promises to their investors defines what their investment mandate is, which will restrict or determine the things they can invest in and what they can't invest in. Investors who invest in their own money, they can invest in whatever they like. Both types of investors usually have as their primary objective return on investment. But in the case of investors who are investing other people's money, they might have a mandate that considers other things. And it would in particular apply to, say, an impact investor or a social venture fund. Similarly, government funds like the National Reconstruction Fund and the Clean Energy Finance Corporation, they have a government policy mandate, which does include return on investment, but also includes other objectives, which are government policy objectives. The reason why this is important is that how these investors approach investment and what they seek in terms of investment terms It will vary depending on whether it's their own money they're investing or other people's money. It will also determine the kind of process they want to use when engaging with you to consider an investment. And we'll talk more about that in a little while. The thing I'd just like to stress is that the two types of investors are not necessarily limited as far as the universe is concerned. They're not really limited in terms of how much they can invest. You can get substantial amounts of money from investors who are investing their own money. Think of, for example, a business. You can also get very substantial amounts of money from investors investing other people's money from a fund. The key difference between the two is that the right-hand column, those investors are all professional investors. They're all seeking to make multiple investments, and they generally have committed capital, which means they can continue to invest in later rounds if the investment is looking good. Whereas on the other side, investors are investing their own money. They might have money to invest today, but there's no guarantee they'll have money available in the future to invest. It will depend on their circumstances. So while there are some big differences between own money and other people's money investors, they do have common expectations, albeit with some different emphases. They have expectations pre-investment. That's when they're sort of getting to know you, doing due diligence on you, hopefully negotiating investment with you, and post-investment, which is what they expect after they've invested. And these expectations will shape how they approach the investment process with you. Now, when you're raising money, you're concerned with the pre-investment phase. You want to get the money. From the investor's perspective, they're thinking long-term. They're thinking about post-investment as much as they're thinking about pre-investment. And so for the investor, the question in their mind is, long-term, is this a good investment? Long-term, do I believe that this team, this business, this opportunity is a good one? Do I believe the team is going to execute well? Do I believe they've got necessary capabilities? So from the investor's perspective, they're thinking long-term. They're thinking about post-investment. And that then influences what they do pre-investment in terms of the kind of due diligence they want to do and the kind of terms they might seek to negotiate. Some of the things that they will focus on is whether they believe the founders are aligned with the investors' post-investment expectations. Do they believe the founders will be focused on success that will benefit investor shareholders? If they don't believe that, then they're very unlikely to invest. Or if they have some doubts but still want to invest, they will seek to mitigate risks through investment deal structure terms or changes to the business plan and the team. So understanding investors' post-investment expectations, their long-term view, is very important for understanding how they'll approach negotiations and due diligence in the pre-investment phase. I've mentioned the word investment process several times, and I'm going to be talking about it a bit more. So just to make sure that you have an idea of what I mean, here's a simplified version of what an investment process looks like. Investors apply stage gates. So at first, somehow they get introduced to you. If they're interested in you, they'll start some level of due diligence. Once they know enough and are confident that things are actually looking good, they will want to engage in some form of negotiation with you. And if that concludes successfully, they will then proceed to try to close the investment. There is usually no commitment to invest until the very last step, when the binding transaction documents are signed. So every interaction through the process is a potential deal killer. Investors use the pre-investment process, the due diligence process, as a way of assessing not just the merits of the spin-out, but also the capabilities of the founders, the people in the business that they would be backing. And this is a really important point, because Investors expect to deal with founders, the people that would be backing to make a spin-out successful. Now, in normal startups, that's obvious, but with university spin-outs, there are more stakeholders and relationships to consider. Even so, investors still expect the founders of a university spin-out to prepare and manage these relationships so that investment is possible. They don't want to deal through other people. So while intermediaries, whether they're advisors or technology transfer officers, can introduce investors and support you through the process, investors will insist on engaging with you directly. This direct engagement is a really important part of their due diligence process. They're assessing you through every interaction. Now, as I said earlier, there are many different types of investors, and they're all going to have their own approaches to due diligence and investment process. And they're going to emphasize different areas to a greater or lesser degree. What I'm showing you on the slide here is a table which is indicative of the areas all investors will seek to understand and verify to some degree during a due diligence process. When I mentioned the spin-out key success factors at the beginning, number one was a sound strategy. Sound as in a good strategy. Now, strategy covers the categories of market, so who's the customer, product, and also the target business model. What's the type of business model or business we're seeking to build as part of the plan? So that part of it is the strategy. And before attempting to engage with investors, it's essential that you've figured that part of it out, because investors will expect that you have a sound strategy. If you don't, it's really hard to engage because you can't communicate how the business can be successful and why it will one day be a great business. In university spin-outs in particular, investors are going to look closely at product, especially evidence for the performance of the technology and the defensibility of the IP and the spin-out's rights to the IP. They will also want to confirm the opportunity is real and large enough to be interesting, and that the advantage afforded by the technology is real. They want to understand the vision for what the business will become and the rationale for the target business model that you're planning to build towards. And by business model, what I mean there is, what will the business actually do? Will it manufacture a product? Will it be a licensing business? Will it use the technology to enable a service? So business model describes the architecture that you're trying to build towards. And that also determines how the business would make money. They want to understand how this plan could create good exit options to realize return on investment for the investors today, years into the future. And investors are realistic about timeframes. I know it's going to take a long time to get a return from an investment in a university spin-out. Typically, they're expecting it's going to be 10 years. But they want to understand that it's possible to make a good return before they invest. It's not something they're going to take a chance on. They want to know that it is possible, but by no means guaranteed. They'll want to understand the team and their capabilities, and in particular, the team's commitment to making the spin-out a success, and whether the goals of the team are aligned with those of the investors. As investors are always minority shareholders and never in control, they are relying on the founders to earn a return on their investment. Hence why so much importance is attached to alignment of goals and interests, and understanding the ambitions and motivations of the founders. These are very important for investors to understand. And they'll want to reach that understanding during their due diligence process, during the process of getting to know you. If they don't see alignment or sufficient alignment, they're not going to invest. Now, investors will look at the fifth column on the end, the terms of investment. Investors will look at terms of investment in the light of their perceptions of the strengths, weaknesses, opportunities, and threats that they see in the other four columns of product, market, plan, and team. They'll only bother negotiating terms or starting negotiations if they think product, market plan, and team on balance look good, they will seek to negotiate terms that give them a reasonable chance of a high enough return on investment to justify the risk. As I said earlier, realistically, at university spin-out stage, investors would not be expecting an exit in less than 10 years. They may seek terms to mitigate what they regard as key risks. And what I'm going to do for the rest of this presentation is discuss some of these key concerns or key risks that investors have and how that will then influence how they approach negotiations if they feel motivated to invest, if they can come to a good deal. So I've picked 4 areas of concern for investors. The top 2 are common to all startups, including university spin-outs. The bottom 2, in particular, apply to university spin-outs. So I'm going to talk about each one of those a bit more to help you understand the investor mindset, the investor expectations, what investors are looking for, what they're sensitive to, and therefore how they may approach investment negotiations with you. And I think it's really important to understand that because that can help you. It can help you with the process. It can help you manage the relationships. It can help you come to a good deal. So the first one was about business plan and confidence, the confidence investors have in the founders of the spin-out and their ability to execute that business plan. So the slide shows an example of a high-level 12-month business plan with quarterly activities and milestones. It is just the first year of that multi-year sound strategy, that key success factor number 1 that I spoke about at the beginning of the presentation. And this is the first year of implementation of that strategy. The activities and milestones shown on the slide would be typical of a spinner that was commercializing a hardware or software technology. If it was a medical device or a biotech spin-out, it would look different, of course. Regardless, investors expect you to be raising enough money to complete the next 1 to 2 years of your business plan, during which valuable milestones can be achieved in time for you to impress investors and raise the next round of funding. So investors need to be convinced that this plan is actually a good plan, a smart plan for your spin-out and its opportunity. And in looking at this plan and understanding what you're proposing to do and how you're proposing to use the money, they're going to be highly sensitive to 2 key risks. The first one is what I mentioned already, which is your ability to actually execute the business plan. In those key activities, whether it's in technology development, customer development, production, delivery, or fundraising, they're going to be looking in those activity streams and saying, can this team do that? Are there things they're relying on or things they're dependent on, third parties, for example, that could slow things down or cause delays? The ability to actually get through that plan and achieve valuable milestones, which then puts the spinner in a position where it can raise more money because it's demonstrated achievement, it's demonstrated success on the steps towards its future. If those milestones can't be achieved, if those demonstrations of achievement can't be achieved, it's going to be very difficult to raise more money. And so the investor's primary sensitivity here is how likely is it that you'll be able to achieve those milestones and complete this plan before the money runs out? So that's a very important thing for the investor because right now, what you're doing is you're asking them to fund that plan. And their main question or concern in their mind is, and where does that get us? Will that put us in a position where we can go on to the next phase? Will that put us in a position where people, other types of investors, other investors, including ourselves, will want to invest again or invest more? So that's the short-term plan, but it's so important to the next stage and the long-term plan. The second area of concern or sensitivity for the investor is going to be their confidence about the management of the spin-out that they would be investing in. Now, naturally, your first priority, which we've just discussed on the previous slide, is to make progress with activities in your business plan and to adapt as necessary, because things will always not go according to plan. There's always going to be variations. There's always going to be surprises. You need to adapt. That's your first priority, right? To manage through that. But there's all this other stuff to manage too. Some of it's planned and regular and predictable. Some of it's driven by events, which may not be predictable and would be surprises. Investors know from experience that all this other stuff is necessary and can happen. And so when they're looking at the team, the spin out, the support the spin out has available to it, they're forming a view about your capacity, not just your capacity and capabilities, not just to execute your business plan and achieve those milestones. They're actually looking at also considering all the other stuff that you're going to deal with to varying degrees over the course of that next 1 to 2 year period. If they have concerns about capacity and capability, they may insist on changes to your plan, your team, governance. By that I mean some level of supervision over key activities or decisions, and the minimum funding amount, the minimum amount of money that needs to be raised now to provide contingency to mitigate these risks or to reduce these risks. Some of the things that they expect to happen post-investment, which is a function of management, which is therefore the responsibility of the founders, is they expect to have information. How are things going? They expect to have frequent, regular reporting. They may insist or negotiate for the right to appoint a director or a board observer to ensure that they're really close to everything and have an ability to do something if necessary. They may want to have the right to approve important business decisions and large expenditures, just to make sure that mistakes are not being made. Another key risk for investors is that a founder or a key team member may leave during this next 1 to 2 year period. This is why many investors prefer teams of 2 to 3 co-founders to the more risky situation of a single founder startup. It's also the reason why many investors like to have founder vesting as a condition of investment, to keep founders focused and to discourage anyone from leaving early. Now, if you don't know what founder vesting is, briefly, what it means is that at the time, if investment is proceeding as a condition of investment, effectively what happens is the founders will have the legal right to a certain percentage of equity in the spin out. But in terms of their economic right to the equity, that will be conditional on them staying in the business, typically for 3 to 4 years. Their economic entitlement will increase gradually over that period. The idea being is it's a form of golden handcuffs to discourage anyone from leaving early, leaving others to do all the hard work. But really, the reasons why investors want that is because if the founders leave, the investors think, well, they were the people we were backing. If they're going, then we don't have a business. Most investors are not in a position to step in and take over the running of the business. So keeping the founders reasonably locked in is a very important consideration. The third sort of concern which investors have, and this is very much the obvious area of, I guess, potential concern and negotiation when investors are looking at university spinouts, is their right to commercialize and profit from the IP, right? A normal startup that's not a university spinout owns its IP and all its improvements. University spinouts often start with a limited or conditional license to develop and commercialize the IP. Naturally, investors want the spin-out they would be investing in to have unfettered rights to fully develop and commercialize the IP and to profit from it. They also want royalties to be set at a level that will allow a high enough return on investment to flow through to shareholders eventually in the distant future. On the other hand, universities who have ownership or rights or of historical IP, they seek to maximize their royalties from that and to manage risks of the IP being potentially underexploited. The spin out, the licensee abandoning efforts to commercialize. And so naturally, the universities are pushing in the opposite direction to the investors. So this looks like a win-lose negotiation. But compromises are possible and deals get done all the time. But it's really important to understand how the investors see this. Universities can have their policies about how they would like licenses to be, but policies have to confront commercial reality. And from an investor perspective, things like restrictions on territories or countries, restrictions on fields, and limited exclusivity, investors interpret those as those kind of DD areas I was talking about before. They see them as limits to the size of the addressable market and therefore the size of the opportunity, allowing competitors to emerge, allowing information to leak to competitors. They see royalties as potentially extracting too much value and suppressing return on investment potential to levels which just don't make an investment worthwhile to begin with. They also see rent seeking, nothing being contributed going forward. So a part of the negotiation that happens is around what is the licensor or the university going to do for the spin out going forward? Well, improvements mean further development of the IP, usually because of the investments and activities by the spin out. What the investors expect is the spin out, whatever the spin out invests in and develops, it owns. Investors would also want to know that they had, in good faith, first rights and any improvement university research might make to the IP going forward. First rights means they have the first right to make an offer, to get the rights to that new IP. And lastly, at least in Australian licenses of the universities, sometimes there's an assignment option where, so long as certain conditions are met, the licensee, the spin out, can actually buy the IP in total and own it. Investors really like that because ownership is much more valuable than a license. And investors want control over the IP protection and enforcement. They don't really want a third party to be managing that because it's in their commercial interest to manage the IP protection and enforcement. However, there's a price to pay for that, and investors appreciate that. So that's why most university spin-out deals progress through the stage of license. And then if there is an assignment option, it happens sometime maybe 2 or 3 years later when things have gone well, the spin-outs raise a lot of money, and they can afford to buy out the IP. So this is the obvious area for negotiation whenever an investor is looking at a university spin-out. But the important thing for founders or researchers who are wanting to jump into a spin-out or be part of a spin-out is that they need to have done the groundwork on this license. Investors can be useful as part of the eventual negotiation on the final license deal, and maybe the license can be somewhat renegotiated because of investors' interests and requirements, which would be a better outcome for the founders and for the spin-out. But it's very important to start off the process before you start engaging with investors, knowing that you have an appropriate license or agreement in principle as to what the license would be, that you have a term sheet that is sensible. This is part of what I mentioned earlier about investors expect to deal with founders. They expect the founders to have put in place the essential ingredients for a spin-out, which includes getting the necessary permissions and authorities from their university, which includes a sensible approach to the IP and the license terms that would be applied. The fourth area that I wanted to discuss was the cap table. Investors care deeply about the structure of the cap table, not just for their own interest, but also whether the people they would be relying on, the founders, the people working in the spin-out, whether that's full-time or part-time, but the people that are actually driving the value of the spin-out, whether they have sufficient equity incentive, both to begin with, but also through successive rounds of dilution that will happen as a result of further investment if the spin out is successful. The table you can see there, it's simplified cap table. Basically, it shows shareholders in the university spin out, where you've got founders who are working in the spin out, you've got other inventors who are not working in the spin out. They might be in the university continuing as researchers. You've got the university itself. You've got the investors this round, the investors in later rounds. And each row represents the percentage shareholding or share of equity of those different groups at different stages in the life of a spin out. So at foundation, you might have a situation where at foundation, the founders have 80% of the equity in the spin out. There are some other inventors or researchers that have 10%, and the university has 10%. Those numbers will depend on, obviously, the situation. But what's important is that the founders working in the spin out need to start off with enough equity at the beginning of the process, because as you can see from what happens from round to round, that equity gets diluted. And the numbers are just, they're just made up numbers. They do all add up to 100%. But the key point is that dilution will happen from round to round. What the investors care about is what happens not only to their own equity, but remember, investors also have the option of investing more money in later rounds to protect their position and maintain their equity percentage. But the founders generally don't have that option. They don't have the money. And so what the investors see is dilution of the founders' equity over time. And they want to make sure that the founders, the people they're relying on, have sufficient equity, sufficient incentive to keep doing the hard work to make the spin out successful. And if the cap table is such that the founders who would be working in spin out are starting off with too little equity, and perhaps the university or other inventors who are not in the spin out have too much equity, then this is going to become a complete barrier to investment and a very important negotiation point. And investors, generally speaking, will take a dim view of what they regard as dead equity or passive equity. That is, equity that's held by shareholders that are not going to make any future contribution to the value of the spin out. Not going to work in the spin out, not going to do anything for the spin out, not going to invest in the spin out. So when investors see that, they will always seek to negotiate a deal structure which rewards those who are making forward contributions at the expense of those who are not. And there are numerous tactics investors can use to try to achieve that objective. For example, the use of an employee share option scheme or share incentive scheme is one way they can compensate the founders working in the spin out, as well as other team members working in the spin out, at the expense of those who are not. And this becomes very much a live negotiation issue if the cap table is unbalanced. Okay, so that's bringing me towards the end of the presentation. I'd love to have a discussion with you and answer questions. Before I do, I'm just going to flip to the advertisement for next week's webinar, which I think is highly relevant because I've just been speaking about what drives investors, what their expectations are, what their worries and concerns are, what their objectives are, what do they care about, how that influences their approach to investment. And the webinar next week is how to, when you're in a negotiation, how to approach it. And it's negotiation 101, that understanding the other side's perspective is very important. So hopefully I've made a small contribution to that understanding in this webinar. It's a big topic. 45 minutes isn't a lot of time. Hopefully I've covered some of the key points for you. Over to questions.
Also, I've opened up the poll. If everyone can fill that out, that would be very helpful. Besides that, any questions in the chat, please?
I can't see the chat at the moment, Callie, so I'm kind of relying on you.
There are no questions coming through.
No questions, seriously.
No, I've got none. Oh, Here we go, from Andrew. Can you please expand a little on various types and rationale universities take with respect to royalties, etc., and how this is viewed by investors?
Sure. Well, I'll just back up to that particular slide about license. Oh, look, there's chapter and verse available from various experts around licensing. I wouldn't profess to be an expert in licensing, but I do know some people who are. Can I just say that there are well-established benchmarks to those who are licensing professionals as to what fair royalties look like, what's reasonable. But from the investor's perspective, it's about whether the royalties, in the case of this spin-out's business plan, this spin-out's potential, and what would need to happen for those royalties to actually become real. That is, the business has actually become valuable and is generating income somehow. Investors look to that. So investors are not going to be swayed by whether the royalties are within benchmark. What they're going to be swayed by is, do the royalties make sense for this business as an investment case? Some of the problems that I've personally experienced with university or research institution license royalty deals is licenses where not only are they taking a cut off net revenue, and sometimes what they define as net revenue is too broad. Not only are they taking a cut of net revenue that the spin-out receives, they also seek to take a cut of net revenue of sub-licensees of the spin-out. And that can be very difficult for the spin-out, first of all, to enforce or to negotiate. So there are real traps in royalties which can make a license a bit toxic for investors. And it's best to sort those things out at the beginning rather than later on. So all I can stress to the person who asked the question is, there are plenty of licensing experts you can consult with. If you are a founder contemplating a university spin-out, take some advice on that, because your university might have standard license conditions. They may or may not be in line with benchmark. That's really going to depend on the situation. And then respect the investor's position, which is, I don't care about benchmarks. What I care about is whether the license deal makes sense in the context of this spin-out and its business plan.
Perfect. We have two more questions in the chat. The first one from Ken. Is there any further perspective on triggers in IP agreements? Any general thoughts on what is appropriate?
Yeah, look, there's lots of triggers. I get triggered by them all the time. One I've just been triggered by recently is a license which has a milestone condition or requirement that is it's binary. Basically, what it does is it says, you must complete these activities by this date, otherwise the license is terminated, no discretion. There's no kind of made best efforts, reasonable efforts, or anything like that. It's a hard termination. I'm looking at that as an investor going, well, hang on. We know things always go wrong. We know there's always delays and stuff-ups. And yet this license is saying you've got to absolutely nail your planned milestone date. That's just nuts. There needs to be more flexibility and reasonableness applied to that. So that's one.
And then from Ian, we have unis are not good at capturing IP, only want to invest in guaranteed winners. How do we overcome this?
There's no such thing as a guaranteed winner. So that's pure folly. There's always going to be risk. You've got to take risk to make money. And I think universities need to find the right balance between the risks that they're prepared to take and allowing others to take more risk and not standing in the way of risk takers. The only way that IP will get commercialized is if people who are willing to take a risk are rewarded for it. And that's the key.
Perfect. And then Mark has put a recommendation here, but Chris is wondering, I wouldn't accept as a founder to have less than 30% equity, 50% equity in my own business after funding rounds. Do you see this occurring regularly?
It happens all the time. So the most successful founders are the ones that typically end up with 20% of $1 billion business. Yeah. So you don't get fixated on the percentage. Focus on the value. It's the old smaller slice of a bigger pie argument, right? it's inevitable that founders of successful startups or spin-outs eventually will be diluted below 50% control. However, the other shareholders will be probably your allies will be other shareholders who see the world the same way that you do. So it's not the case just because you drop below 50%, you're no longer in control. Founders will always be the most important shareholders in any startup or spin-out, even if their equity is below 50%. They will always have the most influence. They'll always have the most ability to set the direction, to influence the key decisions or make the key decisions, because they are the ones who understand the business and are working in the business, even if the business has grown, even if the management team has expanded, even if additional people have been hired to help lead the business. The founders will always be incredibly influential, and the investors and shareholders know that. Most successful businesses have founders who are no longer legally the controlling shareholders, but effectively, they're incredibly influential.
Okay, we have one more from Silas. Thank you, Richard. As an experienced investor, what are some of the most common mistakes you've seen a PhD student or researcher at a university make in creating a startup that led to its failure, and how to avoid them?
Well, I guess if I go right back to the beginning, right? I go back to, where was I? So I suppose the first thing is spend the time and take the necessary advice and consult with people who know more than you do about building businesses, about how to take your idea forward. Get that sound strategy figured out, because you might have a really fascinating technical innovation, but it may have a very small market, or it may be too expensive to produce so that no one's going to actually buy the service or the product that the technology enables. So there's some basic stuff you've just got to make sure is sound at the beginning. That's the most important thing. I guess my advice would be, be your own investor. Put your investor due diligence hat on, be your own investor, and look at it through the lens of someone investing in your idea or your spin out, and ask yourself, is my product, service, technology, is it a lot better than what currently exists? Is there a big enough market? What type of business do I think I can build around this? What is the plan for doing? So in a way, investor due diligence is just the inverse of the creative process that founders have to go through, thinking about their opportunity and how they're going to build a business. The investor is basically marking your homework. The question is, did you do the homework?
Okay, we don't have any more questions in the chat. Thank you very much, Richard, and thank you everyone else that has attended.